Hi everyone, we are now going to begin our education on taxes. So we're starting with chapter 1. Please remember you're going to be learning about federal individual income taxes. But in order for us to really understand taxes, we have to start from the beginning, and that is, what is a tax? Where do they come from? Why do we have them? What different kind of taxes are there? So we're going to look at taxes from a general perspective in chapter 1. So let's get going.
In chapter 1, we're looking at generally what taxes are. So you get your feet wet a little bit. We're going to demonstrate how taxes influence basic business, investment, personal, and political decisions. What constitutes a tax and the general objectives of taxes? Why do we have them? Describe the different tax rate structures. That's something special we used in order to calculate a tax. And identify the various types of taxes at the federal, state, and local level. And the last thing we're going to look at in this chapter is how to apply appropriate criteria to evaluate your alternative tax systems. So who cares about taxes? And if you're following along in your book as well, that's the first objective we'll be looking at. Who cares? Everyone cares. Businesses especially. A business will worry about taxes because different types of businesses are taxed differently. So how should they form as a business? Should they be a sole proprietorship, a partnership, a corporation, a special type of corporation, a limited liability company? So businesses, before they pick their ultimate form, will look at the taxes associated with each. Where should the business locate? Now, we're going to be focusing on federal taxes in this class, but states have taxes and local governments have taxes. So a business is going to look at those taxing authorities as well to see, where do we want to go? How should business acquisition be structured? How should we buy the business if we're buying one so that it has the lowest tax implications? How should the business compensate employees? How much? What kind of taxes are associated with that? Some more questions they worry about. What's the appropriate mix of debt and equity for the business? Should the business rent or own its equipment and property? What's the tax implications of each? And how should the business distribute profits to its owners? There's tax implications there as well. So as you can see from a business perspective, there's a lot to worry about when it comes to taxes. And these are just some of the questions that are asked, and the tax implications are then looked at. Here's more information. Who else cares about taxes? Well, individuals. We don't even have them here, but individuals, you and I, beyond being a business, are worried about our taxes. We care about them. That's money we have to pay out of our pocket to sustain the government. Speaking of government, politicians. They often distinguish themselves from one another based on their tax rhetoric, what they say about taxes. And there's a great Taxes in the Real World, Republicans versus Democrats on page 1-3, and their perspectives on you may know from your own experience on politics is that Republicans are for less government, so that means less taxes, lower tax rates. Democrats are more for a more centralized government involvement, and so that takes more taxes to run the government. So voters must have basic knowledge of taxes to evaluate the merits of each tax proposal. And we're in an interesting time right now where there may be some major tax changes. I'm waiting because for the past 8 years, we had a Democrat president, and they're usually the ones who start the process of tax reform. And now we have a Republican president with a Republican-controlled Congress. So I see major tax law changes occurring, which we're going to talk more about in the next chapter. And there we are, the individuals. Why do individuals care? Like I said, we have to pay taxes. It's part of our everyday life. But some questions you may ask yourself as an individual: should I rent or buy a home? Well, there are special tax incentives for people to purchase a home. They get tax deductions for home mortgage interest and real estate taxes that they pay on their home. That could reduce the after-tax cost of owning a home. Would you like to retire? You have to look at the tax advantage of saving for retirement now for your future and how it will be taxed. Those are just two little areas. So yes, individuals worry about taxes. So we took a little look at who cares about them. And, we can talk for a couple hours or days even about who cares about them and the different types of tax. But just to give us a flavor of this is why we're here. Now, what qualifies as a tax? A tax is a payment required by a government, so it could be federal government, state government, local government, that is unrelated to any specific benefit or service received from the government. So you're not paying the government to get something back from them. It's just a funding source for the government so they could provide whatever benefit or services to whoever. You're not getting it directly. Key components in calculating a tax and part of a tax: the payment required, the payment imposed by the government agency, whether it be federal, state, or local, and the payment is not tied directly to benefit received by the taxpayer. So those are the components of a tax. You got to pay it. It's imposed by the government, and there's no direct benefit you will receive. So let's take a look at an example here. What are we talking about? Which of the following constitutes a tax then? Well, payment for your driver's license. Well, let's say you're paying the government, usually the state. It's payment that's required to drive, but you're receiving a benefit, the right to drive, right? So that's not a tax. That's a fee. Payment for required by government house appraisal. Again, going through. Is it required? Is it, yes. Is it an amount you have to pay to the government? Yes. Are you getting a benefit of it? Yes. You're getting an appraisal of your house. Payment for hotel use of 1% of bill to pay for city projects. Payment for use of a hotel. So it's a payment. It's going to the government. Is it benefiting you directly? No. You're not getting something directly in return from that tax. You're using the hotel room. That is going to pay for city projects that will benefit a whole bunch of people. So that's considered a tax. A payment for the rental car use of 3% of bill to pay for fixing of the roads. Again, it's a payment required. It's being paid to the government, but the payer is not receiving a direct benefit out of it, like you would from a driver's license fee or the house appraisal fee. It's going to general road maintenance, that tax. So that's what makes it a tax. So now that we know who worries about tax and what is a tax, let's take a look at how to calculate it. Sorry, I'm kind of drinking coffee and doing this at the same time, so bear with me. This is learning objective 3. To calculate a tax, you need a couple key components. First of all, a tax base, and the laws define what is actually taxed as a tax base. So the tax base defines what is actually taxed and is usually expressed in monetary terms. The tax rate is the level of taxes imposed on the tax base and is usually expressed as a percentage. So to calculate the tax, you'll take the tax base, what is being taxed in terms of money times the tax rate, a percentage defined by law that you apply to the tax base. And you could think of this if you, a common thing that we all have to deal with is sales tax. The tax base is how much you're being charged for a particular item. Let's say you're in Pennsylvania and you go and you buy a purse. Purses are taxed, sales tax in Pennsylvania. You buy it for $50. Well, the tax base is $50. Then we say, well, what's Pennsylvania's sales tax rate? Well, they have a flat 6% sales tax rate. So 6% of $50, or if I'm doing it in my head quickly, $3, is the amount of sales tax. So this tax computation is generally done across the board for different kinds of taxes. I just gave you an example of sales tax. Now, there's different types of tax rates. What I gave you was what we call a flat tax of 6%. There's what we call marginal tax rate. The tax rate that applies to the next additional increment of a taxpayer's income. So when we start talking about income tax, which is a tax on what you make, your income, which is what the federal government taxes individuals on. That's why we call it an income tax. We don't all pay the same percentage of tax on our income. Again, our tax rate is not the same across the board like it is for a sales tax. We have what's called a progressive, an incremental tax rate. As your income gets higher, the amount of money that the percentage of tax on certain amounts of money will increase. So, for instance, not everybody pays a 10% income tax. On the first level of income, certain dollar amount, they may pay 10%. But as their income increases, so will their tax rate. So what a marginal tax rate is, and you'll hear people refer to it, oh, my tax bracket is 20% or 25%. They're talking about their marginal tax rate. That is what their next dollar of income would be taxed at, the tax rate. The average tax rate is different. The taxpayer's average level of taxation on all of their taxable income is their average tax rate. So if we had a flat tax rate of 10%, your average tax rate and your marginal tax rate would be 10%. But because we go in increments based on income, your average tax rate will tend probably to be lower than your marginal tax rate because now you're averaging all of your income to your taxes. The effective tax rate, the taxpayer's average rate of taxation on each dollar of total income, both taxable and non-taxable. In this situation, what they're saying here is we say, okay, we figure out our tax on income that is taxable, which, by the way, not all income is taxable, which you're going to learn this semester. We're going to divide that, our tax, by all of our income for the year, let's say, whether it's taxable or not. That is your effective tax rate. So we have different ways to measure tax rates. Marginal is what we refer to as my tax bracket, because that's how much your rate will be if you had one more dollar of income. Average is the taxpayer's tax on all their taxable income. What's the average they pay on their taxable income overall? And then the effective tax rate is tax they pay divided by all of their income, whether it's taxed or not. So I encourage you to really look at the examples in the various pages, pages 1.5, 1.6, 1.7 through, it looks like 1.8, to really feel comfortable with what these different types of tax rates measure.
Now, to demonstrate how federal individual income taxes are computed, we are going to use an example. Bill and Mercedes have $160,000 of taxable income. So that's the income their tax is determined on. And an additional $10,000 of non-taxable income. So that's income to them, but it is not considered within taxable income. Using the 2020 married filing jointly tax rate, what is their tax due, average tax rate, and effective tax rate? Then alter that, assuming the following. If they receive an additional $80,000 of taxable income, what is their marginal tax rate on this income? So we're going to need to grab our books and access the federal income tax rate schedule. Sorry, I'm grabbing mine, that are at the very end of your book. In the appendix, I believe. Let's find those. Yes. Wait 1 second. They usually are. And there it is. Okay. So we're looking at Appendix D. So there's a couple different appendix in the back of your book. So we want to go to Appendix D, tax rates. And you'll see there that the tax rates are determined based on what's called filing status. Now, Bill and Mercedes here are going to be married filing jointly. Now, you don't have to worry about how to determine married filing jointly yet. You just need to know that is their filing status. You'll learn that in Chapter 4. So what we're going to do is show you how to use these tax rate schedules to compute income taxes. So first of all, using the tax rate schedule on page D, okay, in your appendix at the back of your book, we're first going to find the tax rate schedule that aligns with the filing status. So married filing jointly, which would be Schedule Y1, left-hand bottom box. And the way we determine tax on taxable income is we find the range of taxable income. So is Bill and Mercedes taxable income between 0 and $19,750? No. Is it over $19,750 but not over $80,250? No. Is it over $80,250,000 but not over $171,050? And the answer is yes. So that's their range of taxable income. So we're going to use the rule to the right to calculate their tax. And the rule says, take $9,235 and add to that 22% taxable income is over $80,250. So $9,235 plus, first find out the difference between their taxable income of $160,000 and $80,250. Now, you're not expected to memorize these rate schedules, okay? We're just showing you how to use them. The difference between the $160,000 and the $80,250 is then multiplied by 22% or 0.22. That is then added to $9,235. So their total tax due, $26,780. So that's how we use these schedules. First find the filing status, then determine the rule you'll use to calculate tax based on taxable income and the ranges that are given in the first two columns. Now the next tax rate we're going to calculate is average tax rate. Average tax rate is the overall tax rate we pay on all of our income. What's very important to remember is the federal U.S. tax system is a progressive system. As your income increases, your tax rate increases. Take a look back to that tax rate schedule at the end of your book. If you're married filing joint, the first $19,750 of your income is taxed at 10%. That's everyone who's married filing jointly. Taxable income between the next ranges of $19,750 and $80,250 is taxed at a higher rate of 12%, but only that range of income. Then, for instance, with Bill and Mercedes, their taxable income was in the next range, so not that entire range, but only the point from $80,250 to $160,000. It's only that portion of their income that is taxed at 22%. So some of their income is taxed at 10, some is taxed at 12, and some is taxed at 22. But if we wanted to find an overall average rate on all of their income, we calculate that by taking the total tax we just calculated divided by the taxable income. So 16.74% is their average income. So for every dollar they have as taxable income, they basically pay 16.74 cents. The effective tax rate is the tax rate on all of their income, whether it's taxed or not taxed. So they had $160,000 of taxable income, but then they had $10,000 of non-taxable income. So in our denominator, we're going to use all of their income, $170,000, and divide that into the total tax on the taxable income, $26,780. So what's the tax rate on all of their income? 15.75%. Or you could look at it as for every dollar of income they have, whether it's taxed or not, they pay about 15.75 cents tax. And then the final tax rate here is their marginal tax rate. Now, marginal tax rate can be looked at really from two perspectives. The first is, a lot of times people will say, I'm in this tax bracket. And that's usually your marginal tax rate. So what's the next dollar of income going to be taxed at? For Bill and Mercedes here, it would be 22%. But what we're calculating in this example is how much that additional $80,000 will be taxed at. So what's just the tax rate on having an additional $80,000 of taxable income? How much is that $80,000 going to be taxed at? And the way we determine that is we first calculate the new tax on $240,000. Now that will be computed by going back to our tax rate schedule. They will now be in the income range of $171,050 to $326,600. So the next rule down from the original rule they used to calculate tax on $160,000. So what they'll do is they'll take $29,211 and add to that the difference of their new taxable income of $240,000, which is that $80,000 of additional taxable income on the 160, minus $171,050. That difference, so I'm walking you through it, you don't see it there. That difference is added to $29,211. That will give you their new tax of $45,759. So the first thing we do is calculate the new tax on the new income because of the additional, in this case, $80,000. We subtract the old tax on the $160,000. So that difference represents the additional tax on the additional $80,000. We then divide that by the new taxable income minus the old, or the $80,000. So the marginal tax rate just on that additional $80,000 of income is 23.72%. Now, that is how we calculate it when you're adding a lot of taxable income. But if somebody said, well, what's my marginal tax rate if I had another dollar of income? We would go back and say, well, what would the next dollar of income be taxed at? So the $1 above 160,000, and that would be 22%. So you could look at it from two different perspectives there. From a $1 perspective, or in this case, what's the tax rate if we add an additional $80,000? First, calculate the new tax, subtract the old tax, the new tax being the tax on the new total taxable income with that additional income added in, and then divide that by the new taxable income minus the old taxable income, or the additional taxable income being added. Okay, so those are your major computations. You need to know how to use those tax rate schedules, and you need to always keep in mind what is average tax, what is effective tax, and what is marginal tax.
Structures. We have proportional tax rates, a flat tax. It imposes a constant tax rate throughout the tax base. Sales tax is a proportional tax rate. Some states have proportional tax rates. Pennsylvania does. It's like 3.1%. No matter how much money you make, it's taxed at 3.1%. Progressive is what we just experienced with the federal government. It imposes an increasing marginal tax rate as the tax base increases. And you just experienced that. As the taxable income increased, that tax rate went up as well. We also have what's called regressive tax rate. It actually imposes a decreasing marginal tax rate as the tax base increases. And an excellent example of this is Social Security. When your wages go beyond a certain level in a year, you stop paying Social Security tax. So if you took all of your income from a job and divided it by your Social Security tax you pay, it will decrease as you go above that maximum level of income. So there is what a chart would look like. A proportional would be a straight line because everybody's taxed the same. A progressive, which is like our federal income tax, which is our federal income tax system, increases as the tax rate increases as income increases. A regressive, like the Social Security tax, decreases overall. That rate would decrease as income increases. It doesn't mean they pay less in Social Security tax. It just means because there's a point in income, I think it's $127,900 this year. Once you make that much in gross pay for the year, you stop paying into the Social Security system for that year. So any amount above $127,900 is not being taxed anymore. So that would cause your tax rate to decrease. All right. So now we're on to learning objective 4. We could talk for days again about the different kind of taxes, but just to give you an overview of them. What we're focusing on for federal purposes, that's the United States government income taxes, personal income taxes. There's also business taxes, corporate taxes, estate taxes, but just some general information. income taxes. Then we have employment and unemployment taxes. Employment taxes on the federal government side would be things like the employer matching Social Security and Medicare of the employees. The federal unemployment tax is also another tax self-employed and, I'm sorry, employers have to pay. Self-employed people pay Social Security and Medicare as well. And you'll see in your book it's referred to as self-employment tax. And we'll be talking about that this semester. So they not only pay an income tax on the earnings from their business, but they also pay Social Security and Medicare. All right, guys. So, when it comes to our federal taxes, income taxes, this represents approximately 58% of all of our tax revenues in the US. Individuals contribute 47.4, corporations 10.6, and they are levied. So individuals pay taxes, corporations do pay taxes. Estates, an estate is are the assets of a deceased person. That's essentially what it is. And trusts, which are special vehicles people use to protect their money. We're not going to get into that, but they all do pay taxes. Again, employment and unemployment taxes are looked at here. We've talked about those. Excise taxes, estate and gift taxes. So I've kind of flew through these talking about them, so I'm not going to reiterate. You guys can go back and take a look, but there's sales and use taxes, property taxes. Oh, this is something I do need to bring up. I forgot to. Is the ad valorem tax. That's what property taxes are. Ad valorem taxes are when a tax is based on the value, the fair market value of a property. Sometimes they call them personal property. Income taxes. Some states don't have an income tax or a sales tax, so it all depends on the state you live in. Alaska, Texas, Nevada, Delaware. These are just some of the states that don't have an income tax. They get their income to fund their government from other sources. There's your excise tax again. They have them at the state and local level. And there's our implicit taxes. So, how do we evaluate the different types of tax systems? Sufficiency. So, it involves assessing the aggregate size of the tax revenues that must be generated and making sure that the tax system provides these revenues. So, that's the first thing we need. We need enough money. So, we need to make sure the tax system is suffice. It will support what is needed. Equity. Fairness. Now, a lot of people will argue here, but the tax burden should be distributed across taxpayers. That is what it should be. Certainty. Taxpayers know they're going to have to pay it, the tax, when to pay the tax, where to pay the tax, and how to determine the tax. So that also needs to be part of the tax system. Convenience. A tax system should be designed to be collected without hardship to the taxpayer. You're going to see, I'll give you an example of that. Sometimes we're promised income today in the future. We might have a contract with someone. We sold them something. We gave them our property and we said, well, pay us equally over the next 3 years. Well, The government will say, well, as you receive the income, pay tax on it. Not in the year you sold it. We don't want to create a hardship because you might have sold it, but you don't have the cash from that sale. So we're going to have you pay taxes as you receive the cash. It also shouldn't be hard for you to prepare your tax return or pay the money that you owe. And that's another thing with convenience. Economy. This is funny. Should minimize the compliance and administration costs associated with the tax system. Well, that's a big screamer right now. People are always yelling that it's just too complicated. And it is. So these are what your system should look like. Do we have all these items present? Maybe to the best of our ability, but some would argue that. Okay, so some more information about sufficiency. We should forecast our revenue. Static ignores how taxpayers might alter their activities in response to a tax law change. Dynamic says, let's see if we make this change, what's going to be the effect of the new tax law? Are we going to still be able to pull in the money we want? Again, equity. A tax system is considered fair or equitable if it's based on the taxpayer's ability to pay. So that's another reason, too, we'll see that progressive tax system. Horizontal equity. We need this kind of equity if two taxpayers in similar situations pay the same tax. Vertical equity means taxpayers with greater ability to pay tax pay more tax relative to taxpayers with lesser ability to pay. And we have a lot of argument in our country over that. So, those are the items that are needed in order to have a good tax system, for lack of a better word, and how you can evaluate the system as to being fair. So, in this chapter, we have introduced you to the concept of who cares about taxes? Why do we need them? Well, maybe not necessarily why, but who cares about them? The influence they have on business, personal, and political decisions. We looked at what is a tax and the general objectives of them, the different tax rate structures and how we calculate a tax, the various types of federal, state, and local tax, and once again, how we evaluate tax systems. So we are all done with our lecture on Chapter 1. I encourage you to get working on your assessments and post any questions you may have.